So this is a series of journal entries to see if you know how entries come into and out of accounts. On January 16th, your company provides 3,800 in services to a customer. So this is your company providing services to a customer, and the customer asks to be billed for the services. So we're going to have an account receivable here. They're not paying us cash up front. We're going to have to get an account receivable on January 16th. So on this date, we provide some services and we have an account receivable. And again, if they're not going to pay us, do we ever provide services? No. We never provide services or good to anybody that doesn't pay us. So if you know somebody's not going to pay, then you don't work or provide them anything for it. So this is the first journal entry that we have to figure out for this statement right here. And then we eventually collect. So on January 30th, your company received a cash payment in full from the customer for the January 16th transaction. Okay, so the question is what are the two entries that go into your books at these two different times? All right, so this first set of entries right here, your company provides services to a customer who asks to be billed for the services. So we have to figure out what our debit is going to be and what our credit is going to be. Now, the hard thing with this one is that when you look at it, there's not the first step of working on things that you can touch. There's not much that you can touch because you're providing services of some sort, right? And so the debit that you're going to have in this is going to be an account receivable. So we didn't get cash. We got what's called an account receivable. An account receivable for 3,800. All right? And our credit, the credit that we're going to have is related to revenue. We're going to have, so we could call it something along the lines of service revenue. This service revenue is going to be for 3,800. This is the first entry. This is the one related to this transaction up here. All right, so we have an accounts receivable, so AR, accounts receivable for 3,800. That is going to increase our assets, right? This account receivable is a promise. It's an IOU that was given to us saying they're going to pay us. And then our revenue is also increasing by the same amount. So everything is in balance on this equation. Our assets are increasing, and the accounting for that assets is revenue. Revenue is making our net income from our income statement increase, which will flow into owner's equity. All right, and so everything's in balance. Now the second journal entry here. All right, the second journal entry for this one right here. So this is number 2. This is number 1. For the second journal entry, January 30th, your company received a cash payment from the customer on January 16th. Well, this is an entry that we're kind of familiar with because we were receiving cash for this account receivable. So start with things you can touch. What can you touch? You can touch the cash. Cash right here. Cash is increasing. We are getting cash. So we want cash to be the debit here, cash. I'm going to put a line here to show the passage of time between these journal entries. It's a very straight line, as you can tell. So cash is increasing in our assets, but we need another entry. We need a credit. Well, what's that credit going to be? It's going to be that accounts receivable of the same amount. So the cash of 3,800 is received, and the account receivable of 3,800 is written off. So the cash will be here, and the account receivable, this account receivable is going away. It is going out of the business. It's gone. It's out of here. Account receivable is out because they already paid you. They paid you with cash. And so once you get this cash, this amount that was debited needs to be credited over. right? And the reason why is to show that they don't owe us money anymore. If you went back to that customer again and said, hey, you still owe me money because you didn't do this credit here, well, guess what? They'd tell you to pound sand. So we have to write that off, and that's what we do right here with this entry.